From the morning reading, the SPX drops and pops on Friday. Spiders, diamonds, Qs, and IWM short-term new high close. 8 of 9 sectors moved higher on Friday. XLV, XLP, and XLB were the strongest sectors, while XLE was the weakest sector. Oil futures fell $1.48 to close at 36.63. Breadth strengthened as advancers led 1.36 to 1 on the NASDAQ. In other news, biotechs lead healthcare higher. Last Friday's message showed that healthcare was the year's weakest sector, and most of that was because of a very weak biotech group. It also mentioned that biotechs were holding back the Qs. For the first time in a while, healthcare is the day's strongest sector, and biotechs are the main reason why. XLV trading just shy of nearly a 3-month high. Recently cleared its 50-day average and may be ready to run at the 200-day average. The XLV SPX ratio is starting to stabilize after falling for the last 2 months. 3 of the top gainers in XLV are biotechs. IBB is trading above its 50-day average for the first time in 3 months and close to a 2-month high. A 14-day RSI line has climbed above the 50 for the first time this year, and its daily MACD lines are at a 3-month high, all of which suggest bottoming action. Hedge funds are starting to become more exposed to stocks. Over the past 10 days, hedge fund exposure has risen to an extreme level, the highest since July. On a longer-term basis, there is still room to see it could become more extreme, but even at current levels, stocks have struggled lately. The short-term risk level has been high for most of March, and it has been wrong. Stocks have not pulled back, other than for a day or two at most. We looked at this kind of behavior at the beginning of March with bullish repercussions. Over the last 30 days, it has reached the third highest failure rate in 16 years, which should be a longer-term positive, but in the short term looks to be too much of a good thing if you consider failures to be good. In other news, the S&P 500 is in the midst of a very solid rally off the February 11th bottom. The rally in February was supposed to be rotation to risk-on areas of the market. The March rally, however, has lost its luster in terms of relative ratios as money has turned more cautious. It doesn't mean we can't go higher, but it perhaps lowers the odds. With the S&P index being higher than its normal PE range and with earnings trending down, the fundamentals are working to pull prices downward. Earnings are projected to improve over the next 12 months, but what are those estimates worth? The previous quarter's estimates proved to be pie in the sky. For now, what do we know is that the S&P 500 is overvalued and earnings continue to trend downward. That has negative implications for future stock prices. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:31 a.m. Central Time, and I'm recording this in preparation for the market day of April the 4th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, the S&P futures were up about 4 points, up about 0.25%. Russell futures up just above scratch. NASDAQ futures also just above scratch, as is the Dow futures. So slightly bullish at the time of this cut, but nothing particularly pronounced. Crude oil down about 0.5%. Euro down about 0.25%. Bonds up about 0.33%, and gold down about 0.5%. Mixed action overseas. China up just above scratch. Hong Kong, though, down fairly significantly at about 1.33%. Japan down about 0.25%. Germany doing better, up about 1%. United Kingdom up a little over 0.5%. In terms of the macroeconomic reports for today in the United States, You don't see but one orange or red flag report, and that's factory orders that comes in before the market opens. And looking forward to tomorrow, would seem we have trade balance, ISM non-manufacturing PMI, JOLTS job openings would round out the U.S. reports for tomorrow. In terms of current market conditions, we have been getting really low of late. In fact, the regular VIX dropped almost to the 13 level. And I think it closed at about 13.10. Short-term VIX, look at this, a 10.92. This is getting into the area where you should start thinking about purchasing some long-term protection or doing other volatility plays. We've not been this low in the volatility for quite a few months. The skew is benign, IV percentile. You see these are very, very low numbers. They're on the S&P a 9, a 14 on the Russell, the NASDAQ a 10, and the Dow a 6. This provides a particularly good opportunity to go ahead and buy some VIX products if you have trading strategies that take advantage of low volatility with the eventual expectation of an expansion in volatility. In terms of standard deviation moves, you got 3 of the 4 indices that came in with a standard deviation up move on a close-to-close basis. So that certainly was quite impressive on Friday. In fact, we'll go ahead and go to the charts. That move on Friday was kind of the classic dip to the lows at the beginning of the day and close at the highs. It was about as strong as you can get. And you see we had a closing high and we had an intraday high on this recent swing action, and we're coming terribly close to this last significant swing, which would look to be, our near-term horizontal resistance. Notice also I have this long-term trend line that's also above us, so we're coming into this area, these 3 stacked similar highs, which are going to prove to be horizontal resistance in an area. And indeed, we're coming, if you look further back, you'd see that we had many, many similar highs all in this area of around 2100 and then just a little bit above. So we've got a pretty significant pocket of resistance that's clustering together just above us. And all last year, all 2015, we were unable to break through this area. So after having this swing low down to the 1800 area to come roaring back up some 300 points right back into this area, it's going to be very interesting to see just what the bulls are able to do with that area now that we're revisiting the zone again. In terms of the Dow, very, very similar story, and you see we're coming into this horizontal resistance and then all these similar highs and then the all-time 52-week high back here at 183.51 on the DJX. NASDAQ has quite a bit more room to go, but had a very bullish action on Friday, so that was most impressive. But you see, it's got it's got to fill this gap and then make a run towards these similar prior highs just to catch up with the S&P and Dow. And then finally the Russell. The Russell also coming into some significant resistance. Here's the long-term trend line. So not much further above us. We'll be told an awful lot about just how strong the bulls really are by how each of these individual index markets respond as they come into their respective significant resistance zones. And volatility, we were talking about volatility, and look at the crush you've had here in volatility during this period in which the S&P went from the 1800 area and you had VIX up here almost to a 30 in terms of the VIX futures. Now we're down here trading around a 15 on the VIX futures product. The VIX itself is, toying with going under 13. And you notice here, we've not been under 13 in quite some time. You got to go back all the way into last summer to be able to get volatility this low. So that's that opportunity that I was mentioning a few moments ago. In terms of bonds, bonds have been moving up, but still are inside the cloud, though could clear the cloud. And if they clear the cloud and you have a cloud breakout setup on bonds, that could be a sign that the equity markets could be getting ready to go down. The fact that volatility is as low as it is, bonds seem to be getting ready to break out, and the indices are all coming into significant resistance areas and zones, could be very much the story of the next week or two. And then let's see, let's take a quick look at gold. Gold's been quite a mess after this huge pattern here, breaking above long-term resistance, breaking out in a big way, formed a bit of a flag pattern, but then ultimately failed and developed something more of a downward channel. We'll see just where that comes. It's coming into some critical areas of support now, and we'll see if it can break out through that diagonal resistance. Okay, I think that's probably enough with the charts. Let's go on to the daily report. And with our daily report, we have, first of all, our intermediate term phase opinion. We're still phase 4, very bullish pattern, price patterns near horizontal resistance. So our expectation from that is that we will be bullish and we'll have various types of price patterns around horizontal resistance and bull flag patterns and so forth until proven otherwise. In terms of the 3 market timing signals, all 3 are pretty supportive of the intermediate term bullish. And you have, with IBD's signal, a confirmed uptrend, and the accumulation distribution score on the NASDAQ is a C+, and the S&P is a B-. So clearly continue to see improvement there. GMI index at a perfect 6 out of 6. That buy signal has been in place since 3-2. And then stock charts, our third mechanical market timing signal. That one has a pretty good stack here between the short and intermediate term, but up against the face of a long-term bearish signal. That is the primary concern that we have across all these market timing signals at this point, is that while the short and intermediate term are clearly biased to the bullish side, we are up against this longer-term bearish setup. And at some point, we're going to have to prove that concept and be able to stack all the time frames together. Is that going to go with the bulls, or is this going to retrace and become, the dominant pattern with the long term being the tell? So there's your consensus on that. In terms of position sizing opinions, both systems, both volatility and the regular portfolio investor systems, are coming in with a 100% opinion. In terms of intermediate term market posture, very strongly bullish across all 4 indices, and that is supported by a weak bullish sentiment line, a weak but improving bullish sentiment line. In terms of the strength of the trend, we have currently a weak but significantly improving, and indeed if we get much more improvement, you see last time we weren't able to get back up over 80, but if we can get up over 80 on this threshold right here, that would be a signal that we have a strong bullish trend. In terms of hedge warning status, still a level 0+, normal with some elevated risk conditions. In terms of special opinions, you see the option income strategies, absolutely VIX acceptable to initiate new positions for novice traders. Do keep in mind that we're starting to get to that area where VIX is very, very low, so an expansion of volatility could be setting up. At the same time, we can't have low levels of volatility for extended periods of time. So we put that as a cautionary statement, yet at the same time, you can't just simply step aside every time volatility is low. It is just isn't going to work that way. Do note that on the cover call strategies, we have adjusted the ratios in this opinion, calling for an even more aggressive bullish position. It's 1 in the money for 2 out of the money strikes for your active positions. Also the same ratio, 1 to 2 of low beta versus high beta. So giving yourself additional bullish exposure, additional aggressiveness with your covered call strategies in alignment with where the market has been telling us its strength is coming in. So in terms of put selling, just keep in mind to have those defined risk positions and position size and the scale you're willing to own. It's absolutely acceptable to initiate new put selling positions in the current market environment. In terms of special warnings, we still have that volatility ratio warning. That's been pretty exceptional. It has not yet closed within the window to fire that off. That would, of course, happen when volatility starts to increase. Notice also that all 5 of our key intermarket risk aversion indicators are still flagging as risk off, so that's a bit of a concern. And then from sentiment, we have moderately high sentiment scores on the short and medium term with stocks, and then with LQD with the individual ETFs. On our fear and greed index, the composite of 7 fear and greed indicators, you see the overall score coming in at a 76. So this has been climbing a little bit and is now up in the upper quadrant of extreme greed. So most of the time when we start to get into these areas, that's when we start to look for those reversal patterns and look for a retracement. So this is by itself not a signal. You have to look for price action to start to reverse, but it's kind of get your radar sensitive because things are certainly starting to become more extreme. In terms of sector-specific intermediate-term market postures, you see there's a long laundry list here, and primary point here is that not only is it a long list, but it's a very healthy mix of both defensive and higher beta. And that certainly is reflected in our current opinion with the covered calls, that you can use a mix of high and low beta. In terms of sector specific percent change, pretty much a sea of green here with the exception of transportation and energy. Of course, Friday energy got hammered. And you see that down here, down 1.39 for the day as a sector, though crude oil, of course, was the primary story there. Telecom also down just marginally, but you see everybody else was strongly up, including both the high beta and low beta sectors. So pretty good mix going on there. In terms of our relative rotation graph, notice that while XLU is still up here in the upper right quadrant where you want to be, as is IYZ, which is telecom, are two really defensive sectors. They're in the strong performing place, but with respect to XLU, you're starting to tail off. Notice who's coming on though. You've got ITB, which is home construction, transportation, and then retail have been coming up, and certainly XRT, especially, and IYT following, starting to head towards that upper right quadrant. So you might want to pay a little bit more attention with those industry groups. Okay, I think that's probably enough for today. We're closing in on 20 minutes. As always, if you find what you're getting from here is helpful to your trading, we would greatly encourage you to subscribe to the YouTube channel. That'll give you a heads up that content has been published. Wait a couple moments after you get that notice. Allow it to be fully loaded up to be able to play back in high def. Indeed, we would encourage you to not just like us on YouTube if you find it's helpful to your trading, but to make access to these special settings, the little gear that's in there. That'll allow you to make sure that you're watching it at high def. That certainly helps. And then the second part is that you can change the running speed of the video to 1.5x, and that'll allow you to watch about a 20-minute video in about 13 minutes or so. So something to kind of keep in mind there. And I'll just scroll through the rest of these today. If you see something that you are interested in, just hit the pause button and then go to that hyperlink and get the additional details. Disclaimers as always, hit the pause button if you need more time to review the disclaimers, and you see down here at the bottom the hyperlink to the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.